person. Are they here? Jeremy? There you go, thank you. Oh, please welcome the Buffs.
Hello everyone, we're the CU Buffaloes from University of Colorado at Boulder, here to present our hold recommendation for Vail Resorts at a price of $306.77 with a 15% upside. My name is David Lozoff.
I'm Steve Miller, and unfortunately our other three team members were unable to join us tonight.
Vail Resorts is a premier mountain resort company serving communities in the United States, Canada, and Australia through three distinct but highly integrated segments: mountain, lodging, and real estate. The mountain segment accounts for 86% of the revenue, lodging comes in at 14%, and real estate is less than 1%. Vail Resorts is the only publicly traded mountain resort company in North America, and it's part of a niche and highly concentrated industry with only 12 competitors in the United States. Vail Resorts benefits from a geographical moat because cost of capital to enter the market is prohibitively high, as evidenced by the lack of a new entrant into the market in the last 35 years. As a company that says our product is the great outdoors, Vail Resorts has a heavy emphasis on the environmental, social, and governance aspects of the company. And this is evidenced through their Epic Promise initiative, which is broken into three pillars: the commitment to zero, the community impact, and the Epic Promise Employee Foundation. Through this initiative, Vail Resorts has achieved 85% electricity emissions reduction through renewable energy. They have given over $1.7 million in grants just in 2021 alone, and they're about a quarter of the way to their goal of energy efficiency savings. We think these aspects make Vail a interesting candidate as a potential triple bottom line company. In 2020, Vail Resorts added Be Inclusive to their already existing 6 values. And we believe this is a subtle nod to the acceptance that Vail Resorts and the ski industry as a whole has misrepresented or underrepresented the minority communities. In 2021, Vail Resorts hired Kirsten Lynch, their first female CEO. They signed on to the CEO Action Pledge for Diversity and Inclusion. They have started the Leadership Development Program for leading diversity, equity, and inclusion. Currently, 4 out of their 9 board members are women, and we think these are acceptable actions they've taken to address their DEI concerns. In order to stabilize potential revenue instability for their projected revenues, Vail Resorts has decided to move forward with a subscription-based revenue model. This is not new to other industries. This may be new to Vail, but in the gaming and the music and the streaming industries, this has been well established. We believe that the 75% revenue mix for their advanced commitment is an attainable and reasonable goal. In 2021, Vail Resorts enacted a 20% price reduction on their passes, all passes. And we're led to infer that they made this decision because they believe that the loss in price will be more than made up for by volume in sales. And as we can see, for past product sales and total lift ticket revenue and other ancillary revenues, year over year, they have gained. And with that being said, this was an acceptable move. However, we are still not at pre-pandemic levels, and we think this is due to a delayed start in the ski season, long lift lines, and labor shortages.
Vail's revenue growth is driven by a strong recovery from pandemic lows and a transition to the subscription-based model leading to future growth projections, and a strong push to ancillary revenue lines also contributing to gains in their top line. We do want to note that Vail Resorts revenue is sensitive to further disruptions caused by weather variability that's contingent to climate change, and then also further disruptions from COVID-19. And with the labor shortage, the brand equity damage that potentially has been done might further impact and hinder future growth. We see that Vail level of debt and cash increased substantially in response to the volatility of the pandemic. We do have concerns with their solvency as we see the 2018 EBITDA to interest ratio falling from 9.74x to 3.61x in 2021. We also see an increase in the liquidity ratios, but a lot of that is driven from excessive borrowing, increasing their cash levels. And we do want to make a note of the 2025 debt obligation due of $1.6 billion. With the potential increase in interest rates, Vail's ability to properly service their long-term debt is a concern going forward. Vail's growth strategy is bolstered by a strong acquisition strategy and a strong commitment to capital expenditure into their current existing portfolio of resorts. Vail has committed a record level of capital expenditure in fiscal year 2022 to invest in more efficient lifts, reducing the lift lines, and current terrain park. They also made an acquisition of Seven Springs Mountain Resort, which is expected to generate $15 million in additional EBITDA annually. Vail Resorts' position as a lone publicly traded company in the ski industry resort business does make direct comparables difficult, but we chose to do a sector level cyclical or consumer cyclical, and then an industry level hotels and entertainment services, and then we chose the EV to EBITDA to capture enterprise valuation, and then the forward PE ratio to capture a more fundamental valuation. We see with the enterprise valuation that Vail appears to be fairly accurately priced, but then when we look at the forward PE ratio, we view it as highly overvalued. And we think these conflicting price targets reaffirms our position of Vail being a unique entity within the public markets. We'd like to reiterate our price target of 306.77. Our cost of debt was found from the effective yield on BB rated bonds. Our cost of equity was found from the CAPM model. Our weighted average cost of capital was found using Vail's current capital structure. And then the terminal growth was found with projected real U.S. GDP growth rate and the target inflation rate. We would like to note with our sensitivity analysis that the weighted average cost of capital does have a material impact on our price target. And with potential rises in interest rates, we do see the potential of that discount factor rising in future periods. Our scenario analysis reveals a wide array of possibilities for Vail's outcome. Further COVID-19 disruptions and further damage from the labor shortage and climate change could drove our bear case. Our base case was from that revenue from the strong recovery, and then also that transition to the subscription-based model with exposures to those risk factors in the bear case. The bull case captures stronger growth, more robust margins, and then that acquisition leading to further growth as well. We do want to make note of some key risks for Vail to consider going forward. Again, climate change, reducing the effective season length, and then the ability to service long-term debt, and then also the pandemic further disruptions, and then also amplifying the labor shortage that Vail is currently experiencing.
So we've shown multiple reasons to be optimistic about Vail Resorts. We believe there's a good chance for a strong rebound in demand from pandemic lows. We see the transition to subscription-based revenue model as a good step to help with variability in revenue expense expectancy. We also have many reasons to be pessimistic about Vail Resorts. This year they experienced damage to brand equity after they had a paltry start to their season. And the revenue variability linked to shifting climate is a serious concern. We'd like to reiterate our recommendation of hold for Vail Resorts at a target price of $306.77. We'd like to open it up to questions at this point. Thank you everybody for your time.
Yes, sir.
I'll start it off with a question just on the labor shortage. Wanted to get your thoughts on, how that progresses and, if the company's given any guidance on that. Do you expect that will continue to maybe pressure margins? I know your base scenario is for flat margins, I think, but, how does that play into that?
Yeah, definitely. With that labor shortage, a lot of it was driven by the pandemic, but then a lot of it is also driven from Vail potentially not paying a livable wage, depending on where these resorts are. And so there has been some suggestion that Vail is going to raise its wages for the following seasons, and with that, it could impact will impact their margins. But we see that as a potential of, again, offsetting the damage to their brand equity, and in the short term, increasing wages will hurt the bottom line. But the long-term damage, especially with the transition to that subscription-based model and reliance on advanced commitment, we think that increasing wages is prudent. And I think really tackling that labor shortage head-on, making a concerted effort to mitigate that within this season and definitely within next season is critical to Vail's success going forward.
Very good presentation, guys.
Thank you.
I am not an equity analyst. I work with M&A, so I find it hard sometimes to just comment a hold recommendation. For me, it's usually buy or don't buy. There's nothing wrong with a hold recommendation, of course. What I'd like to know is if you really focus on the fundamental better drivers for price, growth prospects, margin prospects, and the ability to execute. Are you tending more towards a buy, towards a sell, and why?
Yeah.
I'll just speak for a second. When we first started this project, Vail's price was up in the low 300s. We're talking maybe 330. And we looked at it this morning, and it's down around 255. So our opinion has changed. We started with a much more pessimistic sell view. And I think if we had had this conversation 3 months ago, we would have been much more strong on a sell, and we would have been justified as shown by the price. It's hard to justify a sell at this low right now. We think that Vail has announced that they will be increasing their minimum wage by $2 an hour, if I remember correctly. They are still investing in their CapEx in order to decrease lift lines, add new train parks, and the subscription model, if it can be done properly, as we've seen with, say, a Netflix, it is sustainable. It can be done. And to take it a step further, Netflix has gone from 75% of their revenue being on the subscription-based model. I'd say more than 90% of it is. we'll never, I don't think Vail will ever hit 90% because you'll always have those people who just want to go for a day. But right now, it's hard to say anything other than wait until Vail can prove themselves to come out of the damage that they've caused themselves with their brand equity, with the long wait lines, the labor shortages, which is partially self-inflicted, and we're also interested in seeing how the increase in interest rates over the next 12 months, we expect an increase in interest rates, how that'll play out.
And just to further add on to that point, because we initially did have a sell recommendation when we first came up with our analysis, but we think that the markets really factored in a lot of the risk factors that were driving our valuation at that time. And so the investment is only as good as its current price, and at 307, it does present some upside to its current price level of, it was 266 as of last Friday. And with the risk factors present, we do see a lot of potential for downside, but again, it's that strong geographical moat and the commitment to this business model, which we think is necessary with the potential revenue variability linked to weather. We think those are strong moves. And so, again, with the markets factoring in the risk, and with everything currently going on, we do think that the whole recommendation is merited within this within the current climate.
So, once again, it was a good presentation. I used to be in equity sales, so whole recommendations used to make me nuts, but I understand your reasoning, and it's very well articulated. I have a question about the G aspect of ESG. Do you have a view on how independent this board is? It's supposed to be undertaking this diversity initiative, or is it more related directors?
It's all directors. It's they're all related directors. On their website they have their charters for the 3 different boards. No, they call it a charter. I don't want to say anything wrong. I don't want to misrepresent anything. So I'll stop there.
One concern that we noted as far as the independence is Robert Katz, the former CEO, sits on the board, and with that, we do like, and I'm drawing a blank on her name, Jen. We do like, they do have a lot of strong external board of directors looking at their resume and the value add they bring to the board. Robert Katz and his tenure as CEO, we saw a lot of good things, but we do have questions about his ability to take an objective view on issues. And again, they're making this initiative that we really appreciate, and I think that they have a ways to go, and they're showing progress. And is the resistance, still having their former CEO having so much influence, is that hindering further progress in that realm? And unfortunately, our research was not able to yield a more definitive answer for us as analysts looking into it, but it's definitely a concern that we are aware of, and we acknowledge in our evaluation.
You called Vail a unique entity in the public markets, and I agree. Would you say that entails any specific special challenges for Vail? Why have the other companies left, the public companies left the market in terms of capital, availability, that sort of thing, perhaps?
Yeah, definitely. As a publicly traded company, they do have access to greater levels of financing than some of the private companies, but they do have the pressure, the short-term pressures of the shareholders, and so I think that companies that have been taken privately, I think it allows them to have more autonomy to operate within these the variability that is attributed to a business that is highly cyclical to weather patterns and we see the highs of the weather season, or the winter season, and the lows of the summer season. So I do see it as a benefit having the access to public finance markets, but also the private companies that hold the other holdings have so much more flexibility in their approach that we see pros and cons to being that loan entity. David, do you have further share?
Going back to the geographical mode, when we're talking about Vail and their subscription-based model, they offer many different types of subscription-based passes that you can sign up for. And one thing that's intriguing is I can get a pass for Keystone, or I can get an Epic Pass or an Epic Local. And so for these smaller companies, maybe capital doesn't allow them to get 10, 15, 20 different locations, but they can get one or two. I have to buy that single pass for that one place. And so if I want to go to 2 or 3 different places during a season, I'm going to have to buy 2 or 3 different passes. And that is a strong position for Vail Resorts to be in because they have so many different properties already. They can leverage that fact and put multiple properties into a single pass. And that way people have more flexibility, buyers have more flexibility in where they want to go ski.
All right, that concludes it.
Thank you.